We are guilty as qualitative fund managers, much like the Indian cricket management, of believing that we've got supreme knowledge about local conditions. The Australians were not guilty of that. They said much the same thing. I think Krishnan and Quant signals do a much better job of that.
All our qualitative funds are quality focused. If there is a factor which was dominating our philosophy, it was quality, and quality is underperformed in India for 4-5 years.
And what Krishnan did brilliantly was add a value overlay to that.
So you want to have a balanced exposure to all these main factors, whether it's value, momentum, quality, size, whatnot. Make sure that you're not deficient in any one.
Even the gold ka returns long term are lower than Nifty, lower than S&P 500. Because gold ka correlation with Nifty or S&P 500 is low, there is merit to having gold and rebalancing to gold if the equities pieces run up radically.
What we've realized is when you combine all this along with global, along with REITs, put in gold, it actually encourages investors to stay invested for longer in a strategy. In a multi-asset kind of a construct or a multi-factor kind of a construct, typically you would get that consistency of return. So the investors stay invested for longer, brings in that patience, and hence you can harvest the fund return that much more better.
Hello and welcome to the latest episode of Marcelus Musings. My name is Pramod. I'm one of the founders of Marcellus. Today's episode is a special episode because we're here to commemorate a 3-year anniversary of quantitative investing at Marcellus. And to discuss this in detail, I have with me my colleagues, Saurabh Mukherjea, who's the CIO and founder of Marcellus, and Krishnan, who's been leading our efforts on the quantitative research side. So we'll discuss a few things about quantitative research. A little bit of background, as many of you might know, in the US now, well and truly, passive funds have overtaken active funds in terms of assets under management, largely given that active managers have struggled to beat the index over the past many years. But very few have heard about something in between these two. You could argue that these are passively active. Some call them factor funds, some call them rules-based funds, quantamental. They go by various names. Rather than me telling you more, I would rather look at the expert here amongst us. Krishnan has spent more than a decade on this subject, working at firms like Morningstar, Goldman Sachs, and D.E. Shaw. So Krishnan, to begin with, can you give us the basics of what are we talking about? Rules-based investing, factor investing, what does it mean in reality?
When we say rules-based or systematic investing, it's nothing but a series of steps, right? A series of rules to create the final portfolio while minimizing discretion, right? Just following a series of steps to create the final portfolio while minimizing discretion, and human biases as much as possible, right? And you can have a whole spectrum of how you define the rules, right? So it could be as simple as, for example, creating a simple index, right? Which is the simplest rules-based or quantitative portfolio you can think of, right? So if you think about a Nifty 50 or a Sensex, right, it's nothing but the top 30 or the top 50 stocks in India by market cap, right? Of course, you have other things like, for example, free float, liquidity, so on and so forth. But that's essentially you're just selecting the top 50, top 30 by one characteristic, which is the company size. Right. Now you can also take this to, again, you can, like I said, it can be simple, it can be very complex, or it can also be, for example, just basis, just statistical analysis of prices, right? Which is what a lot of high frequency trading firms do, right? For example, if you take the Renaissance Tech or the Citadels or, the other hedge funds of the world, which they are basically using, just pure statistical analysis of, prices to come up with these rules. Right. The other way of doing it is the way we do it, which is to use fundamental insight or combine fundamental insight, economic intuition, right? And basically coming up with why we are applying or coming up with those rules, and obviously combining it with price-based measures like valuation, momentum, so on and so forth to create rules-based portfolio. We call that, again, the quantamental or quant plus fundamental style of investing, which is what which has been our approach to quantitative investing as such.
In some sense, index investing is also rules-based investing, right?
Exactly.
Except the indices the constituents in the portfolio to free float market cap, which is the most commonly used. What's the problem with that?
So firstly, if you just select stocks basis the size, right? It's not. Again, you can think of it as just saying that is it a good idea to invest in companies simply because they are the biggest in terms of the size? Because typically, if a company is today the biggest in terms of market cap, typically it would also mean that it would be among one of the biggest in terms of revenue, EBITDA, so on and so forth, which means by definition it is probably matured, right? So it's probably the market leader in whichever industry it is. So maybe it's not going to grow at a pace, right, which would have probably grown at the past, or to the point it has got to, right? So what that means is it's not just investing based on the size of the company. Could be one way of obviously building quant portfolios, but it's not the best way, right? It may not be the best way. It may not get you the best returns going forward, right? It might help you reduce risk. For example, you're just investing in large cap stocks in that case, but it will not necessarily help you generate the best returns.
Yeah, it does seem counterintuitive to investing in indices which track market caps, because if the market cap goes up tomorrow as a result of the price going up, the index increases the weight of that. So therefore, if you're an index fund tracking that index, you'll buy more.
Yeah.
That seems to go against the holy grail of investing, which is buying low and selling high.
Correct.
As a passive index fund investor, you seem to be doing exactly the opposite.
Exactly. So that's also one reason why someone might not prefer to just do passive or index investing, right? Or that might not be the best way to create rules-based portfolio.
Right. So turning to you, Saurabh, you've been a qualitative investor all throughout. You've done bottom-up research as an analyst, as a head of research, as a CIO. What sort of prompted you to look at Krishnan and invest in this whole new wave of investing? I remember going back to your book, Coffee Can Investing. In some ways, that was pretty much quantitative investing, right? Two simple rules of 10% revenue growth, 15% ROC, blindly buy and hold for 10 years, and you beat every index over long periods of time. How did you marry your background in qualitative versus quantitative?
So I think a couple of things happened. So 4 years ago, when we started hearing about AI coming to the fore, right, I started thinking as to what will AI do to qualitative investors like us? And my read was and remains that gradually AI will make it harder and harder for qualitative investors to make money, because AI will figure out how the qualitative investor works, and to some extent AI will game that, right? With that in mind, we reached out to a group of people 4 years ago. Krishnan was the most talented amongst them. But whilst we were interviewing Krishnan, something happened which convinced me that hiring him will be the right step forward for Marcellus. So what happened was, I told Krishnan, you have to read Coffee Can Investing. Infuriatingly, 4 years ago, Krishnan said he hadn't read the book. So I thought, oh my God, what's going to happen now? We had
heard about it.
He'd heard about the book, but he hadn't read it, right? But then he read the book. And then I still remember, it was a Zoom call at 8 p.m. one weeknight.
Yeah.
Krishnan said, look, it's fine. This is good, 10% revenue growth, 15% ROC is all very good. But as the Indian market gets more efficient, these sorts of algos will effectively, he was polite about it, but effectively he said these sorts of algos will get competed with. The market will discount the returns from this, right? And as he said that, right, suddenly I remembered I had an analogy which flashed through my mind. So I played cricket through school. So, when we were in class 5 or 6, I used to watch on TV that in the slog overs, what you're supposed to do is go down the track, get to the pitch of the ball and whack it, right? So I used to do that in class 5, 6, 7, and it was damn effective. I used to feel very thrilled that I have managed to slog the bowler. But as I tried to do the same in inter-school cricket matches, right, as cricket got more competitive, and as I entered my class 11, 12 cricket, it didn't work because the opposition bowler could figure out what you were going to do, and they used to either bowl a bouncer at you or bowl you a wide full toss, so that you couldn't, just going down the track wouldn't be enough. And suddenly that analogy came to me that as the Indian market gets more competitive, if people like us want to do systematic investing, remember AI will come out at the qualitative investor. So if we want to do systematic investing, we need a professional guru of quant investing who can take different rules, who can name different types of systematic investing and overlay onto algos like Coffee Can Investing, overlay onto that more effective filters, which is what he's done. What Krishnan's done very effectively for us is overlay a bunch of 3 or 4 rules which complement each other to produce a market-beating result, right? I don't think we could have done that with our qualitative skill set. And my submission to those who are watching is, as the Indian market gets deeper, more competitive, more liquid, we will need professional quant investors to manage our money, and professional quant investors themselves will have to work harder and harder to produce results which are useful for investors.
The Indian market is becoming deeper is interesting because we're seeing IPOs by the dime a dozen. Now, if I go back to my life as an analyst, when I used to cover IT services, you had a dozen odd listed companies. You could still claim to be an expert in a sector. Today, if you add IT and internet stocks, the plethora of names, and if you extend that to a cross-sector analyst or a fund manager, practically speaking, how many businesses or industries or business models can a human fund manager stay on top of to claim any circle of competence? Would that also be a factor driving move towards quantitative research?
Yeah, absolutely. So, say for example, it's just the benefit of breadth, right? So when you look at what quantitative fund managers do, or how this the quantitative portfolio construction work, it basically works because you have so many companies, right? The breadth, right? So you can compare, say for example, you can take a thing like, for example, it could be profitability or just gross margin, right? And you can compare that, you can calculate this for all the stocks, right? And you can compare it all on a consistent basis, right? So you can, for example, the way we do our forensics, right? What we call as clean accounts, right? So basically we are calculating these 10 ratios, right? On different measures, right? Where we're looking at cash conversion, whatnot. But we're doing this across 500 stocks, right? Which is our investment universe. And because that's done in a, in an automated, kind of a codified fashion, right? I'm pretty sure if you have to do it on an Excel sheet, or, if you have to just do it with a team of analysts, right? It's going to be very clunky. Right? So this is where a quantitative approach, right? Where you can compare on, a very wide universe, right? And you can calculate, metrics, and you can compare that over a wide universe of stocks, right? Also what happens is, remember, when you rank something, any metric, right? Against a very large population, the meaningfulness of those ranks also increases, right? I give this, this analogy, for example, of, someone, if you want to judge someone's engineering skills, right? Would you, for example, look at their ranks in IIT joint entrance, right? Or maybe, where they stood in JEE main, where like 15, 20 lakh people are appearing, every year? Or would you look at their rank in their class, right? In science, right? Which one would be a better
The bigger
measure?
the peer set, the more meaningful the
More
rank.
meaningful the ranks are.
Understood. So you have more number of companies in India today available, so therefore there's more data
The
points.
signal is more valuable.
Signal is more valuable.
And also we have a longer time series, I guess, pretty much say post the liberalization of the early 90s. We have got 30 years of stock market data, fundamental data.
And if you roll this forward, each passing year, the quant signals that Krishnan is extracting, then the signal value of that is going up, the noise is reducing.
Right. How then do you answer the fact that you said, take for example, your batting style in the slog overs was figured out by the competition. Given that the market is inherently a complex adaptive system, presumably some of these signals also get priced in eventually.
Yeah, so it does, and that's where I think I think every fund manager, whether they're qualitative or quantitative, will end up becoming a mixture of quant and qual, right? So if we take, say, our global team, the global team is using quant to get to a long list of, say, 150 stocks. And then from that long list of 150 stocks to their final 40 stock portfolio, they're using qual. But I've seen that to get to that long list of 150 stocks, they keep changing the underlying filters basis where they think value in the market lies. If they think that, say, a traditional value has got overpriced, then they swing the style, and then their screeners, they put in growth related metrics, right? So the ability of the fund manager to understand where does value lie in the market today, where does opportunity lie, will become a central part of any fund manager skill, whether they are quant or qual. So let's take the simplest example in India. The weight of small caps in the Nifty, the weight of small caps in BSE 500, I think around 1.5 years ago was the highest in at least 30, 40 years. The weight of small caps in BSE 500 was the highest in 30-40 years. Now, Krishnan had to use his judgment to say that, look, this sort of weight of small caps, given that small caps account for say 20% of market profits, they shouldn't be accounting for 30% of the market cap, right? And hence his judgment was, we still use quant filters, we still use quant screens, we use rules, but we also realize that value increasingly lies in large cap quality. So we use the accounting rules to identify clean, well-run large caps. We use the same quantitative construct that Krishnan built 3 years ago, but we use our common sense to say that increasingly, because of polarization in the market, because of excessive money going into small caps, value in small caps might be harder to find, value in large caps might be easy to find. And I've seen our colleagues in the global compounders team are using similar sorts of judgment to say value in Mag 7. Value in Mag 7 might be harder to find, value in American small cap might be easier to find. That mixture of skill and rules, right? That mixture of skill, that mixture of judgment and rules. That mixture of judgment and rules will be the killer combination in the years ahead. I suspect it always was, just that the level of intuition required on judgment and the level of skill required in framing the rules will rise every year. And to sort of take a cricket analogy, the Women's World Cup final, Harmanpreet Kaur getting Shefali Verma to bowl was clear intuition, right? There's no way any coach would have said Shefali Verma, who's never bowled in World Cups, should be brought on to bowl. Shefali Verma, by the way, folks, entered the World Cup only in the semi-finals. So Harmanpreet Kaur calling Shefali Verma to bowl in the World Cup final is clear case of intuition, right? Shefali Verma then executing to plan and bowling a tight line and length, getting 2 crucial wickets in 3 overs is skill, right? It's not as if Shefali Verma was just an average trundler and was given a go. The captain's job was to use her intuition to say this is the right person. That specific person's job was to execute as per a well-honed set of rules that high quality cricketers follow, right? Similarly, Krishnan or indeed our global compounders team. Judgment to figure out where does value lie in the market, and skill embedded in rules to squeeze that value out for our clients.
Just to add to that, so again, fundamental investors using more quantitative techniques, right, is one way, you can see, this whole evolution happening, the convergence happening between quant and discretionary. But the other way it's also happening is, with the explosion of alternative data, right, and various tools, available at scale for us to process that data, you have a situation where even quant investors are able to better leverage, what was previously, I would say, the domain of, say, a qualitative investor. Say, for example, extracting sentiments from, say, the earnings call of a company, right, or from the earnings transcript of a company. Because of, say, generative AI today, right, things like natural language processing, you can do it, for, again, a lot of companies, right? So nearly all the companies today, in fact, in this earnings season, right, to the extent you have the earnings transcript or the audio, you would be able to use an LLM to, for example, extract the earnings call for almost all these companies and then, rank these companies on sentiment, right? Basis what they said in the earnings call. Which, maybe 3 or 5 years back, you would say that would be an exclusive domain of a qualitative fund manager or a qualitative team, right? So again, just the explosion of the alternative data and the tools available and the computing power available to, use this data in investing means that increasingly, again, you see this convergence, whether it's quant using more fundamental data or discretionary, or, what was the domain of discretionary investors 5 years back, and discretionary investors also increasingly using quant tools from what they were, say, 5 or 10 years back.
So in some ways, a style of investing, let's say quality, as we've seen in coffee can investing, the 10% revenue growth and 15% ROC is traditional domain of a quality investor who looks for quality in the business, which has significant capital allocation opportunities for reinvestment to consistently generate that 10% revenue growth. So effectively, you're codifying the philosophy of a quality-focused fund manager. Similarly, I'm sure there are other styles, whether it's value or momentum, which become codified, and hence quant increasing effectiveness.
Yes.
But one of the reasons the proponents of quant investing talk about is that we as human beings are prone to our own cognitive biases. And therefore, wherever judgment is required, while we might think that we are making that judgment based on intuition, there is an equal likelihood, I don't know what's the probability of that likelihood, but we've all experienced in our own lives when it comes to decision making, often we let those biases come through. And that's an argument a hardcore quant proponent would say. The best service you're going to do through rules-based investing is use the best of human beings, which is to be able to create the rule, and leave out the worst of human beings, which is the cognitive biases. So I know you're a quant practitioner, so you won't have any doubt about that. But from somebody who also runs qualitative funds, how do you get over this innate tendency of the human?
I think. Look, it is a massive human flaw. We in the qual world suffer from it. Krishnan suffers from it less. I think I'll use a cricket analogy to illustrate this again, right? I remember the great Australian cricket team which dominated cricket from, say, the mid-90s through to around 2010. And almost always they used to play the same team. Whether they played in Australia, England or Pakistan, they was roughly the same people. Maybe they would have one extra spinner and one less medium pacer, one less fast bowler, right? So Damien Fleming might come out of the team if they were playing in India, and they would add a second spinner to Shane Warne.
McGill would blow,
Exactly, right? But by and large, 11 people, and they came and beat India in India 2004 famously. They lost to us famously in 2001. But they came back with much the same formula, much the same rules in the Krishnan world. They came back the same investment rules, much the same team, and won in 2004 famously. In contrast, if we look at the Indian cricket team today, we changed the team so much between various tours that you struggle to understand, whether it's the same country that was playing, say, India versus England 3 months ago versus India versus South Africa recently, right? So this is a simple example of Australians saying, look, we'll have much the same 11 on the playing ground, regardless of where we play, rule. Our team, the Indian team management saying we will mess around basis our discretion, right? And we can see the downside of that, as our team management believes they know better than most people and they're using the pitch, the local conditions to mess around with the team. We're ending up with poorer results than with going with the same team, right? So this aspect, right, and we are guilty as qualitative fund managers, much like the Indian cricket management, of believing that we've got supreme knowledge about local conditions. The Australians were not guilty of that. They said much the same team. I think Krishnan and Quant signals do a much better job of that. Now the acid test of this will come when, as I was saying, as it becomes apparent that some rules, as the market gets more efficient, some rules are getting gamed out by the market. The juice is being squeezed out of that, right? The trick will be to figure out, okay, now this rule has been maxed out. Market efficiency is caught up. I now need to add more layers to the rule. At which point do you do that? At which point do you know that the market is giving an emphatic signal that the rule has been tapped out, juiced out. Let's move to a more complex rule. That I suspect will be the next challenge for us as we go along this quant journey with Krishnan.
Yeah, we've already seen that, right? Given that all our qualitative funds are quality focused. If there is a factor which was sort of dominating our philosophy, it was quality, and quality is underperformed in India for 4-5 years.
And what Krishnan did brilliantly was add a value overlay to that.
Correct. So Krishnan, if you can just give us a sense of how do you blend these different factors? First of all, you might want to introduce what are the broad factors at play, and how in a house like Marcellus, which is known for quality, how have you blended the other factors to create something very unique?
Sure. So when we talk about factors or styles, these are nothing but company characteristics, right? At the very basics. So for example, when we started out, I didn't mention, market cap indexes, right? So that's one style of investing. So if you are just investing in large cap stocks, right? So you are basically investing on the size factor, right? Now, if you take another example, right? So if I just shortlist all companies basis, say how profitable they are, how efficient they are, basically looking at the return on capital measure, or how much cash flow they generate, free cash flow they generate, that's one definition of quality, right? So that's quality style of investing, right? Now, when you think about, again, these different styles or factors, you can think of them as, again, I like to think of them as, nutrients, right? When we take in food, right, for example, right, we might want, certain types of food actually, but what our body essentially needs is those basic nutrients, whether it's proteins, vitamins, minerals, again, you name it, right? So in the same way, you can think of, again, when you are building a portfolio, you want to have a balanced exposure to all these different styles, which have proven to be, which are proven to generate returns, right? Enhanced return over long runs, right? So these, again, some of these factors, like I mentioned, right? So again, I talked about quality, I talked about size, but you can also take in, say, value. Value, again, you're just looking at cheap stocks, right? Momentum, you're just looking at, things that have worked in the past, right? Now, all these are factors which have been shown to work globally. So they're pervasive, right? They have been shown to survive transaction costs, right? And they have been shown to be persistent across time, right? Again, this is not something that, again, I'm telling you, you can just read it up.
We didn't
right?
make this up.
There's a lot of literature on this. Obviously, the original proponents of this were two gentlemen, Ken French and Eugene Farmer, right, from University of Chicago, who kind of, wrote some, couple of seminal papers in early 90s, right, which kind of gave birth to this whole area of factor investing. But essentially what it is, essentially this nutrient concept, right? So you want to have a balanced exposure to all these, main factors, right? Whether it's value, momentum, quality, size, whatnot. Whereas you want to make sure that you're not deficient, right? In any one. So you want to have a diversified exposure to these factors. And to the extent you have exposure to more uncorrelated factors, the better, right? The reason again is, when one factor is not working well, and factors are also cyclical, like any asset class returns, they are also cyclical, right? So typically you want to, if you have two uncorrelated factors, right? For example, value and momentum, right? So when value stocks or undervalued stocks are not doing well, typically you would assume that, again, it's been shown that again, momentum stocks do well, right? So and vice versa, right? So it's like,
something was working. So गाड़ी का एक पहिया चलता रहे.
एक पहिया चलता रहे. So again, that's the whole principle of, building multi-style, multi-factor portfolios, right? You're combining, these uncorrelated factors in a way, so that, again, you get high returns. At the same time, you lower your risk, right? So the risk-adjusted return.
Very interesting. That's just like a chef, right? So every chef effectively is serving, if you want to make a chef sound boring, he's serving carbohydrates, proteins, minerals, vitamins, etc.
Balanced
diet. But the skilled chef, the people who run Michelin-starred restaurants, they're serving the same mixture in a delicious way. And the local...
It's how you blend these things,
That's
which
right.
is the difference, I guess.
Yes. Exactly.
So what you're saying, a single factor strategy like a quality only or a value only will also go through significant bouts of underperformance and outperformance, which inherently makes it uninvestable for the loss aversion oriented human being. But by mixing factors, you're saying you're able to reduce the volatility without compromising on the returns as well. For that, these factors need to be uncorrelated.
Yes.
Presumably, they also have to involve an element of rebalancing.
Correct. So if you, for example, we have done, we did some research earlier this year. So if you look at two factors, for example, value, quality, right? Over a 20-year period, value would have, given comparable return to, say, the quality factor in India, right?
So return roughly same aata hai over long periods of time.
Over long periods of time, right? So over a 20-year period, 25-year period, in fact, both of them have given almost same, returns, right? So you start from the same point, you end at the same point, right? But what's happened is, there are periods, for example, value has done really well. For example, pre-GF, the global financial crisis from early 2000s to like 2008, value did really well, right? So cheap stocks were, they did really well when you look at the returns. Whereas quality was again lagging then, right? But from post-GFC to 2020, just before COVID, quality has had a great run, right? And then value has, done really well over the last 5 years, whereas, quality hasn't done that well, right? So you kind of see this over pretty long periods of time, right? Where one factor does really well, the other factor, again, in this case, value and quality are, uncorrelated to some extent. So you kind of see this in action, right? And again, like I said, right, when you blend this, in this way, right, and you you combine this, and this is what we have tried to do in in our quantitative strategy, right? We are combining uncorrelated factors, and you obviously have the initial filters, right? Basis the quality filters which we have, and then we select basis valuation, and then we rebalance, right? Now, where does rebalance come in here? Rebalance is nothing but a periodic refresh of the portfolio, right? If for systematic investors, this would be refreshing the portfolio using the set of rules, the stated rules. So again, if you, for example, we'll have the initial filtering steps. We'll select basis, say value, whatnot, and then you basically review this portfolio, say every quarter, every once in 6 months, depending on what your rebalancing frequency is. That's exactly what rebalancing is, right?
So Bertrand Russell बोला है कि the sign of a civilized mind is the ability to hold two opposing ideas
thoughts,
and still function at the same time. So effectively, what you are teaching us is the ability of a great quant manager is to hold 4 opposing ideas: quality, value, momentum, size, blend them, and not just function, deliver a stable portfolio at the same time, right?
Is it Russell or Fitzgerald?
Oh, Fitzgerald, sorry.
Fitzgerald.
Fitzgerald after his marriage fell apart, उसको समझ आया कि the ability of, so going back to cricket analogy, John Wright, another one of the best coaches India had, he was happy with Sehwag in the team, he was happy with Dravid in the team.
Right. Yeah.
And he figured out that this is a diversified portfolio, right? Sehwag, Dravid, Lakshman, Saurabh Ganguly, diversified portfolio, and no surprises. That we were a team which won in Pakistan, won in England, drew in Australia,
Almost,
and won pretty consistently under John Wright, right? And yet it is very hard for a manager to be able to countenance different styles, different types of players. Managers like to see जैसा मैं था वैसा मेरा team होगा, right? And therefore that's very, very nicely put, right? This construct that like a chef, you're trying to create a thali with a little bit of everything to give the user a stable, consistent experience across good years and bad years for different styles in the market.
And it's that rebalancing which sort of refreshes each of these factors. And I see you implemented a similar rules-based approach to asset allocation as well. So you're saying that such rules-based approaches not just work in a single asset class like equity-only funds, but on a diversified portfolio of multiple assets. What sort of rules and how are they different from a single asset class that you run?
So when you just zoom back, right? So if you think about factors as a stream of returns, right? In this just looking at, for example, company characteristic, you can have a similar stream of return at an asset class level, right? So you can look at assets like gold, right? This commodity, right? Now again, in India, people look at gold predominantly, right? But you can look at any commodity, right? And you can look at the stream of returns to the extent it's investable. Similarly, you have bonds, cash, right? Within equities, again, all these different styles. Now, research has shown that if you look at some of these asset classes, for example, gold and equities, right? They're far more negatively correlated, right? In fact, the correlation is even lower than, for example, within or among factors within equity, right? Wow. So hence, when you rebalance, right, with uncorrelated asset classes, the benefits of rebalance are even higher.
Right.
So just to be clear, आप बोल रहे हो even the gold का returns long term are lower than Nifty, lower than S&P 500, because gold का correlation with Nifty or S&P 500 is low. There is merit to having gold and rebalancing to gold if the equities pieces run up radically.
Exactly.
Very
so,
interesting.
To just give you, to just give you an example, right? If you have a 70-30 or a 80-20 equity gold portfolio, right? What that means is because gold is a safe haven, right? It's considered as a safe haven, right? Typically, what you see is when equity does really poorly, that's the time when gold will be the, almost like the buffer in your portfolio, right? So that, again, that's the reason where, at that point in time, right, if you rebalance the portfolio, suppose, your equity has done really well over the last 5 years, and the equity allocation has gone from 80%, say, to 90%, you bring it back to 80 and allocate more to gold, right? Then that helps you kind of enhance your return, because typically when equity has done well over the last 5 years, typically you would expect, the expected return to go down, right? So that's when gold comes in. Right. So this where, having this kind of rebalancing between uncorrelated asset classes in a multi-asset setting is even more powerful than kind of rebalancing among factors or within factors in equity. The way we have done it is it's very simple, right? We have introduced as many asset classes, uncorrelated asset classes as possible. And on top of it, that apart from the traditional asset classes which I mentioned, right, we also have REITs and InvITs, which the first REIT got kind of listed in 2019. So again, just to give viewers some context, these are I'm talking about real estate investment trust, which invest predominantly in commercial real estate, right? Then we also have something called as infrastructure investment trust, which invest in infrastructure projects, so for example, gas pipeline, again, transmission lines, whatnot, right? We have a couple of these InvITs also listed. So what we have seen is, again, and this predominantly, again, this is the established asset class. Maybe not in India, it's it's still a new asset class, but in US, it is a pretty established asset class. And typically this is considered to be like, an yield generating asset class, right? Where most of these, both REITs and InvITs, they're supposed to, kind of distribute out more than 90% of their the income they generate, right? So again, when you look at the REIT and InvIT sleeve, you put this together with all the other traditional asset classes along with gold. Again, it's just it gives you the diversification you need. And with both rebalancing, regular rebalancing, as well as so we also do some tactical rebalancing, given opportunistic rebalancing in a way, right? Depending on where we see the expected return of each of these asset classes, and also maybe pairing it with global, right? So what we have done in our multi-asset, the way we have done a multi-asset is even within equities, we have an allocation, for example, towards global, whether it's US equity or global equity as such. Again, what we have learned again from Saurabh and again from the global investing team is again, given the uncorrelated nature, right, especially due to the the currency effect, right, where Indian currency again kind of tends to depreciate, right, when the Indian economy goes for a toss, right? So that kind of adds the uncorrelated the uncorrelation leg. So again, what we have realized is when you combine all this along with global, along with REITs, put in gold, right, it's it gives you the diversification you need, and
it's the only free lunch in finance, as they say,
right? And
so what you're saying is diversifying across asset classes which are uncorrelated, coupled with systematic rebalancing, will give you the lower risk way without compromising on the long-term returns. And indeed, this morning somebody was showing me that one of the country's largest flexi-cap equity fund and country's largest multi-asset fund, both over a 20-year period, have given the same returns. Amazing. But the multi-asset fund, as you can guess,
is more stable,
is given you a smoother journey to it, which is the free lunch. I guess we didn't respect it while we were studying it in CFA.
It's a free lunch, it's a free thali.
Yeah.
It's a free thali, it's not a full-on one meal or the other. So the free lunch, and hopefully the folks in Chicago Pharma French will appreciate this Indian metaphor. The free lunch is actually a free thali that a skilled quant investor can provide. And just to stick with the cricketing analogy, RCB, Royal Challengers Bangalore, the reigning IPL champions, they have Virat Kohli, that's your nifty, but they also have Hazelwood from Australia, right?
Right.
So RCB if you want to win the IPL, you need to have the best that the world can give. So similarly, if you want to win in the global investing league as an Indian investor, you should have also some of the world's best stocks. But the interesting piece, the gold piece, is Cheteshwar Pujara. Right? Cheteshwar Pujara's test average wasn't 50. His test average wasn't 50. He wasn't the nifty. Right? He wasn't nifty. His test average wasn't 50. But Cheteshwar Pujara was diversification of the most profound sort. He was the rock in the middle, in the post-Dravid era.
This is the last Indian test batsman who could play spin.
And that was why he was diversification of the ultimate sort. Cheteshwar Pujara goes, we start losing test matches, bang, 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 bang in India.
We should still get him for the second test.
I think he's commentating. He shouldn't be commentating, he should be playing. Somebody should. I think get the Indian cricket team management to watch this video.
Yeah. And this point on diversification, again, I think people don't get it, intuitively, right? But I think it needs to be emphasized that, when you have a smoother stream of returns, right? Whether it's through, the multi-style, multi-factor investing, which I talked about, or the multi-asset investing, which I talked about, it actually encourages investors to stay invested for longer in a strategy, right? And in that way,
because the returns are stable,
and you can capture more of the fund returns, right? Because typically what you see is a lot of investors, the actual returns, right, that tends to lag the fund returns, right? Because they enter and exit at the wrong time, right?
Correct.
Whereas in a multi-asset, kind of a construct, or a multi-factor kind of a construct, typically you would get that consistency of return, more smoother return stream. So the investors stay invested for longer, right?
Correct.
Brings in that patience, and hence you can harvest the fund return that much more better.
Interesting, because when, say, equity as an asset class inevitably goes through a drawdown, people panic and get out. But the naysayers of a diversified strategy says that the same works the other way around. When you are in a multi-asset strategy, but a pure equity strategy is outperforming, people would fall for greed and run for a high-performing return. Apparently, in real life, that doesn't happen. People are less worried about FOMO of greed, but loss aversion, as Kahneman taught us, is the bigger driver of that bias creeping in. So you'd rather lose out on short-term outperformance for that ability to stay invested, which in turn gives you the long-term outperformance anyway. Just to wrap things up, have to ask the elephant in the room, AI, how are you leveraging AI, if at all, in qualitative research, given that it's going to creep into the broader subject of quantitative? Before I bring in Krishnan, any sense of...
So I think our research team, the qualitative research team, is already using one of the LLMs. It's a bittersweet thing, right? Because we are using the LLMs because it gradually means that we will hire fewer young analysts, because the LLMs actually are doing a pretty good job. So if you want in-depth 50-page report on the Indian hotels and hospitality industry, you just need to spend 15-20 minutes asking intelligent questions of the LLMs, and you get a solid 40-50 piece of research. It's not something, say, that a senior analyst with 10 years experience will produce, but it's something that a junior analyst with 3-4 years experience will produce, which I think means that it'll be increasingly tough for the youngsters to get jobs. And my worry, Pramod, is that as the AI gets better and better, ever more senior analysts' roles will be supplanted by AI, especially analysts whose job is to do sectoral qualitative research. That then suggests that the strategist, right, the strategist who's able to see across sectors, across themes, is able to spot discontinuities, right, that sort of person will become even more valuable, whether it's in our erstwhile avatar as a sell-side analyst, or indeed in the buy-side, right? Even in the buy-side strategists are able to turn to the fund managers and say, look, I can see a discontinuity coming. We won't think about it before that discontinuity come, and say AI comes and slams the Indian economy, upends the whole consumption model. That sort of strategic view will become very powerful. But I think with not just us, I think several of our rivals have also started using AI for their quality.
Well, ironically, look, both of us were junior analysts at some stage. We've gone through the grind. In some ways, that process over the last couple of decades has built some intuition. You as a strategist looking at multiple areas of the market and connecting the dot. But over the next decade, we don't use junior analysts. Who will be the guy to connect the dots 20 years hence?
So if you're a pessimist, you'll say that, hey, there won't be anybody, and hence there'll be an opportunity for the few people who can join the dots. But what I'm hearing about is increasingly universities and business schools are getting students in their second, third year to start doing the sort of research we actually did through our 20s.
Using AI as a tool. So you're already starting off your career with a junior analyst to support you.
And if you're running a business school in India and you're not doing it, I would suggest think about it, because increasingly, if you just have a normal DCF type analyst graduating and knows how to read the balance sheet and P&L, that's not going to go very far. That sort of work very few employers are going to pay for. Already by their second year, I think most analysts should be able to use AI tools and combine that with basic understanding of finance, so that by the time they graduate, it's almost equivalent to somebody who's done 5 years of research in an equity research role, and therefore employers will say, okay, this guy or this girl, she really knows her stuff. let's get her in a semi-senior type role.
And we've seen that not just in equity research, right? My friends in advertising talk about junior copywriters becoming redundant, or in law, but these would be the creative directors 10 years down the line, or litigators 10 years down the line. So I guess that process, like you said, reminds me of the fact that at the end of the day, it won't be AI replacing humans who learn to use AI well who will replace humans who don't learn to use.
So it goes back to that famous Michael Lewis book, right? Moneyball.
Right.
So Moneyball was the first big data book I read. I didn't even know it was called big data then. I just read Moneyball thinking, my God, this sort of data analysis on baseball. So folks, Moneyball is about this famous manager called Billy Beane. He was the manager of a baseball team called Oakland A's. And Billy Beane was obviously played by Brad Pitt, no less, in the Michael Lewis wala movie. And Billy Beane hires a quant guy to crunch numbers on, कौन सा player कितना मारता है baseball में, value for money, which player is value for money. And that triggered the whole wave of quant analysis by football managers, I'm sure by the IPL coaches. Right? Effectively, Krishnan has bought Billy Beane and Oakland A's to finance. And just as what Krishnan does is intensely competitive, so is being an IPL manager. I think in that context, for many years, MS Dhoni and Stephen Fleming, when MS Dhoni was a little fitter and Stephen Fleming had the benefit of a good CSK team, they were the Oakland A's, they were the Billy Beane of India, right? Very balanced team, same process year after year, inevitably resulting in a last 3 finish for CSK, right? I think that whole construct, bringing quantitative rigor, balance, discipline, rebalancing, same process year after year, boringly exciting or boringly successful. CSK, I think all the way till 2020, even the first year after COVID, 2022, I think was their last title. Boringly consistent, boringly successful. Same Stephen Fleming, MS Dhoni formula trotted out the year after year. I think we'll have to bring that to qualitative investing for it to be successful. But as soon as I say that, it sounds like quantitative investing.
Yeah, so in your world, Krishnan, AI, is it possible for AI to sort of replace you, where machine learning would mean that it can second guess the movements of the market and become self-reinforcing in terms of new factors, new strategies coming through, or you still need a human being to overlay insight on it?
I think given where LLMs are, or generative AI is today, or where the state of the technology is today, I don't think we are still at a point where AI, whatever AI you call it, right? It's at a point where it can independently take investment calls, right? Because there are a lot of I would say factors, decisions which you need to take, which still requires a bit of human involvement, right? So even when we talk about quantitative strategies, right, the design of quantitative strategies, right, the rules which you actually put in, that itself requires a bit of judgment, right? Like I said, right, our approach to quantitative investing has been that we use a more fundamental, driven, process to do that. Because we will not do something unless we understand, why that rule should be there or why that rule should work, right? So we have an investment hypothesis in mind, which we then try to test it out, right? That could be, the research which we do, right? So it could involve a back test, it could do scenario analysis, whatnot, right?
So given the computing capability now available, won't those back tests and scenario analysis become very routine? You can do several back tests in a matter of seconds and minutes, and therefore, whatever strategy you've created can get competed away by somebody else in the market who's doing this at double speed.
Sure. So it depends on, again, like I said, the economic reasoning, right? Why should that particular characteristic or, the rule actually should work? Has it worked in the past? Why has it worked in the past? If it's going to work in the future, why will it work in the future? Right? So like I said, right? So suppose you think about quality, right? So there is a good reason why profitable and efficient companies, companies with high return on capital, they should generate I won't say returns, right? At least they should have a higher valuation, right? So to the extent they're able to reinvest back into their business, right? There's a good reason for it, because they obviously their asset base is going to grow at a much higher rate, right?
Right.
It's like as simple as it gets, right? Now, there is a reason why then that those companies, to the extent you have valuation guardrails, right? Those then should ideally generate higher returns. So there's a reason why, that kind of investing or that rules will work, right? Now, if you put in a machine to do this or to find a rule, what it might end up doing is, at least given the current state of affairs, right? Because it doesn't have that economic intuition, right? It doesn't know that, this particular rule has worked for this reason in the past, and this is the reason it will actually go and work, it should continue working in the future, right? So I think, there's a great risk that you might have, for example, the classic correlation example, right? That correlation is not causation, right? So it would confuse the correlation with causation, right?
Right.
Which is, I think, as fiduciaries, right? Especially if you're managing, someone else's money, right? You need to be, you need to have that sense of responsibility, and you need to know what you're doing, right? It should be transparent enough. So I think we are not still there, right?
Right.
So that's going to be a challenge. And then, look, I'm very excited about machine learning, right? Machine learning is, again, a bunch of statistical tools, but what it allows you to do is capture higher order relationships, right? And to the extent you understand what you're doing, right? It could still help you, kind of understand, for example, the styles we talked about, right? We want to understand association between styles. Instead of just looking at correlation, can you look at higher order relationships, right? Nonlinear relationships. Can you look at, for example, interaction, right, among these factors or styles? So again, that's very interesting area of research. A lot of work has been done, and I think to answer your question, right, your previous question, right, that could be something where researchers could distinguish themselves, right, as these common, cookie clutter factors, right, or the more common factors, those get arbitraged out, right. So that could be one way for you to distinguish, or a good quantitative researcher or a quantitative investing team to distinguish themselves. And look, for people who say that machine learning is abstract or it's a black box, I just tell them that, look, the human mind is the ultimate black box.
Absolutely, yeah.
Right?
I was going to say that. Human intuition is equal
right.
Black
So
box,
because
right?
you don't know.
Why did Harmanpreet get Shefali Verma?
Yeah,
Exactly.
So it is codified in our minds. So, I was worried thinking, at the end of the day, human intelligence is also pattern matching, right? Which is no different from what generative AI is doing. And if you say no, generative AI has hallucinations, it's probabilistic. Investing is probabilistic.
To be fair, I think I agree with you. To be fair, where Krishnan is going at is, hopefully Krishnan will not say that. Krishnan will not say that the rally in small caps has been caused by global warming.
Right.
Right. Whereas AI would know any better if you said rally in small caps has been caused by.
I would be surprised if a fund manager said that in real time. We all hallucinate as human beings. But what both of you are saying is that, look, at the end of the day, these are tools. The people or the human beings who are able to use these tools better will eventually win. We won't get displaced. So on that happy note, that we'll all have jobs and we'll be able to do another podcast.
I spoke to an AI expert last week. He assured me I'll have a job 5 years hence. So I was very happy with him.
No, thank you, and congratulations once again, Krishnan, for 3 years of
Thank you so
qualitative
much.
research. Thank you, Saurabh, for being here, and thanks to you all.